right, so this is going to be another concept that's going to help us actually find the higher probability setups in terms of support and resistance, supply and demand, and in terms of our methodology overall, because this is really what's going to be helping us in making these decisions when it comes to our supply and demand levels and our support and resistance levels, and that's going to be buying and selling pressure. Now, the concept itself is very similar. It's very easy to understand. It's nothing more than as simple as when buying pressure is occurring in the market, is when the majority of traders are buying, thinking that price will increase. Vice versa, when there is selling pressure in the market, selling pressure occurs when the majority of traders are actually selling, thinking that price will continue to decrease. Now, one thing you have to remember is that for every single buyer, there has to be a seller willing to sell him those contracts or whatever the case might be but what happens is the volume itself. The buyers are going to have more volume, meaning that there's more buying pressure than there is selling pressure, and the sellers are going to have more volume when there's more selling pressure than the buyers, meaning that they're looking for price to go short. Now we're going to go into the actual charts and look how we can incorporate this into our trading and actually look for live examples. So now that we're in the actual chart, and pretty much what we're going to be doing is starting off by actually marking off our major levels of support and our major levels of resistance, but I kind of want to do this with our supply and demand levels, right? So what we're going to be doing is looking at it from a bigger picture perspective, right? Notice how at one point in time there was actually buying pressure at this specific price, and then we had a second rejection. Notice how buyers came into the market at this price here, and then notice the big reactions we had each and every time after price actually rejected this. This gives us an indication, and again, what you want to look at is the move itself. This gives us an indication on how much buying pressure there was at this level of supply and demand at one point in time. But notice how sellers actually broke through this level of supply and demand, that there wasn't enough buying pressure. Again, once this level actually broke, there wasn't enough buying pressure like there was here and here for buyers to actually continue to hold this price. Not enough people were looking to continue to hold that level in terms and create a new buying opportunity, and sellers broke right through that level, right? Now that sellers have broken through this level, look at the selling pressure that this previous level of resistance or previous level of support or supply and demand had all this buying pressure. Right now that sellers are broken through, look at how they're starting to form some selling pressure at this area. Notice how price tried trading higher and tried trading above, because remember, but you want to think about it as a tug of war, you want to think about it as a battle. Look how many times sellers fought to break through this level. When they finally broke through, what's the probability of sellers actually holding this level, and how much pressure or how much selling pressure is there going to be at this level to create another opportunity for us to actually look to hop in on a short position and see if price actually goes short? Well, look at all this selling pressure that's currently going on here with this current price action, right? Notice how buyers tried pushing price up, big rejection. Notice how buyers tried pushing price higher. Day after day after day, we had another huge rejection. Now price is currently trading here, and again, we're really going to see the buying or selling pressure at this point in time during London session or New York session, where more volume starts to come in into the market. Because remember, what causes these breakouts are the amount of orders being placed and the speed of which those orders are actually being placed, which we will see in the data printed here on these candlesticks, right? So again, the more selling pressure there is, the more volume there will be for price to actually go short. Now, very simple concept. I don't want to keep it more than that, and it's literally the same exact thing vice versa when it comes to buying pressure. Want to keep it short, want to keep it simple, because this isn't something I want to spend too much time on, because the concept is so simple, and you'll pick up on it very quickly. If you have to, just rewatch the video, but I don't want to make it more complicated than what you have to really understand and how it's really going to be incorporated into our trading. Because the more you start making things complicated when it comes down into trading, the more difficult your trading is actually going to be, and you don't have to know every single detail of why this terminology is called this and why the market does this when it hit, or why the market does this, and know every single detail to become an excellent trader. Really, you have to be able to just manage your risk. So I don't want to focus too much on concepts that are so simple and break them down to the T. Right, the concept should be fairly simple when it comes down to buying and selling pressure. When it comes down to your support and resistance or supply and demand levels. And again, this applies to both support and resistance and supply and demand. Yo, what's going on, everybody? Welcome back to another video. So in this video, we're going to start talking about more technical aspects of trading and what really goes on in the markets and things that you're going to experience. So pretty much what we're going to be talking about in this video are liquidity grabs. Now, what we're going to cover in this lesson are stop hunts, liquidity grabs, which are pretty much the same things, and liquidity pools. Now, what is a liquidity pool or a pool of liquidity? Liquidity pools are levels where the bigger players make decisions and large amounts of orders hit the market at these levels. These levels are typically found at areas of supply and demand. This is why we see really big moves happen at these levels of supply and demand, and this is why we want to take trades at these levels of supply and demand. Now, there's going to be times where you may take a trade outside of a level of supply and demand, which is perfectly fine. Just know that you shouldn't really be looking to increase your lot size on that specific trade. The trades that you really want to, really increase your lot size, and I'm not talking about going crazy on with the risk, risking 10-20%, but definitely when I'm taking a trade at a level of supply and demand, I'm typically pushing it a little bit more. I'm doing like a 3-4% risk at times. Example, right? This is a liquidity pool. So this is an area, right? Notice this box is kind of highlighted here, this gray one, right? Notice how price, every time it hit this level, it had a big move to the upside, and we had big rejection of this level here, right? This is what we call a liquidity pool. Now, what is a stop hunt? A stop hunt is when market makers try and force some market participants out of their positions by triggering a pool of stop losses. So basically, all a stop hunt is, it's literally exactly what it says. Us as retail traders, we place stop losses. So if the market hits our stop loss, we get out of our position and take a loss. A stop loss is to protect us from, taking big losses on our accounts, right? And market makers know that we have stop hunts, so they intend to hit our stop losses. It's not every single day that this is going to happen, but just know sometimes it may happen. For example, right, 1870.23 is a resistance level here on gold, right? So resistance starts around 1868 and ends around 1872. Notice price came all the way up to let's just say 1880 almost, before going down. Market participants, market makers know that since this is a major level of resistance, there's going to be people interested in selling at 1870, which is resistance. So notice how market makers push price up, and then price completely drops after that. What happened here? Pretty much all that happened was market makers took some of the retail traders out of their positions, or some of the market participants. They triggered a bunch of stop losses with this candlestick here, and then price completely dropped, where typically you would have made a good amount of profit off of this move. The market makers took you out of this move before it even happened, and this is going to happen when there's a big move that is anticipated. Now, the way to avoid this is doing one of two things. Is either you use a bigger stop loss, or you enter after the stop hunt. But the risk you take is not knowing when the stop hunt is going to happen, right? So let's go look for some more examples here. What I mean by this, right? So I'm going to use this marker here, right? And we're going to make this red. And I'm going to draw a zone, which is going to be green, right? Or whatever, let's make it green here, right? So in green, I'm gonna say probably right here, right? So in between these two areas, right? So whatever's in red is typically gonna be where you're gonna find stop losses. Whatever is in green are going to be a bunch of sell orders, right? And I'm going to put this here as well. I'm gonna make this blue, right? So looking at the previous videos, we also learned about buy stops, where a bullish candlestick has to trigger the buy stop. So typically what's going to happen is that people are entering sells in this green box, meaning they're expecting the market to go down at this green box here, which this would not be a bad setup to actually take, right? So let's say I was going to go short there. I could look to even target right here. Right, this definitely wouldn't be a bad setup to take, where we're looking to actually sell at a major level of resistance, which you'll learn later on, right? But this is a level of resistance where typically you're going to find a bunch of people are taking sell orders. And above resistance, we have buy stops. Just in case resistance breaks, people are going to be triggered into buy orders, expecting the market to continue to trade higher. So market makers know, obviously, where people are looking to buy and where people are looking to sell. So the way market makers also make money is by pumping price up, right? Notice the pump started here, ended up here. So they pumped price all the way up, right? Triggering a lot of people's sell orders, triggering a lot of people's sell stop losses. So everybody, or the majority of people that sold, that got stuck in this stop hunt, got taken out of their sell positions. At the same time, they're triggering a bunch of buy stops, meaning that if they entered buy stops here, their stop loss for the buy is probably going to be around this blue level, right? Look what happened right after the market makers took out a bunch of sell orders. It came right back down, anticipating, or where the sell would have played out, and also stopping out the people who bought up here. And price continued to go down and lower and lower and lower, right? So that's one example of a stop hunt. Let's go look for another one, right? So let's check this area right here. Right, I see one right here. So let's go to the hour time frame, and let's kind of go back in time to where we just were. Okay, right. So here's another example, right? And this could be a news event, but this is another example of a stop hunt, right? So notice again, 1795 is a level of supply and demand, support and resistance. Notice how we have support and resistance throughout this blue line. Notice how price was trading under this level every single time it came up to this level. Notice the break. At this point in time right here, this is where people started to buy because support held. So people are going to be placing their stop losses around this area maybe. And some people, just consider it as this entire zone is full, well, green, we'll put it full of buys, right? Let's put this green again, right? So that green area is going to be full of buys, and this red area is going to be stop losses, right? And at the same time, there's going to be a bunch of sell orders here as well, right? And there's going to be sell stop losses up here. Remember, for every buyer, there has to be a seller. Right, so notice how price started to reject. Market makers obviously know that this is a level that people are going to be very interested in trading. So what do? They push price down, triggering a lot of these buy stop losses, at the same time triggering a lot of these sell stops, right? I'm trying to word this very easily so you can understand as best as possible. Because remember, for every buyer, there has to be a seller, right? Triggering all of these sell stops here, right? And then price pumped up like crazy, taking out a bunch of market participants. So those are two real examples. What I'm going to do is kind of draw it out for you guys and explain to you guys what's actually happening here. So give me 2 seconds, right? I'm going to open up software here. We're going to open up Paint, right? So I'm going to draw out some market structure, right? And we're going to color code all of this. So let's just say this is a level of supply and demand that we're looking to take a trade from. And let's say price is currently trading here now, right? Red is going to be our stop losses for the buys, right? So typically if you buy here, you're going to place your stop loss under the level of support, right? And I'm going to make our buy orders in green. So we have buy orders all throughout this range here. So we have buy orders all throughout this range here. So remember, there's two types of buy orders. We have buy limits, and we also have buy stops. At the same time, we have two types of sell orders, right? And we also have market execution, but we're talking about buy limits and buy stops. You know, I'll include it as well. Market execution. And then we have sell limit and then sell stops. In this situation that is playing out right here, the only orders that are really going to be placed are buy limits, buy stops, and sell stops, along with market executions. In this situation, sell limits wouldn't be placed, right? But we know throughout this range, there are a bunch of stop losses for our buy orders, meaning that there's stop losses for the people who bought using market execution, there's stop losses for the people who have buy limits, and there's stop losses for the people who have buy stops, right? Now, typically in a situation with a liquidity grab, the only person that really wouldn't lose money in a stop loss hunt would be the buy stop. Because again, price has to be going up to trigger a buy stop. So in the situation where there's a liquidity grab, which again, liquidity grabs and stop loss hunts do not happen very often, right? But like I said, you know, I'm gonna make the buy stops in yellow. So we have buy stops up here. Obviously, there's pros and cons to using buy stops. Like, you're not always going to get the best entry. You may not always be avoiding a liquidity grab or a stop loss hunt because they don't happen very often. And personally, I just don't use buy stops or sell stops. And we're going to make the sell stops in blue, right? So let's just say there's sell stops here. And we're going to put the stop loss for the sell stop in purple, right? So I'm going to write this out for you guys. So let me mark this off here. So we're going to put here the sell stop loss in blue. Well, blue is actually supposed to be here, right? Blue is going to be our sell stop, and then green we're going to have our buy orders, and then red is going to be our buy stop loss, right? So what happens in a stop hunt is the market makers see all of these orders, right? They can't physically see the orders, but you see pools of liquidity and they know where the majority of people have their stop losses or the market, other market participants, right? So before price actually moves up, and again, stop hunts do not happen very often, so I don't want you guys to get discouraged and feel like you're always being manipulated. But again, the markets are here for us to make money, so we have to play as smart as possible. Does that mean everybody makes money trading? No, that's not exactly what it means. But there is a potential for us to make money. We just have to play it smart and manage our risk, right? Because remember, just because you get stopped out doesn't mean the trade still isn't valid. If you get stop loss hunted, right, and the trade is still valid, you can re-enter the position. Just adjust your stop loss to go under or above the stop loss hunt. There you go. That's a solution for you just in case you get stop hunted, right? So I don't want you guys to get discouraged. But anyways, right, let's say right before the market actually moves up, all market makers are going to do are pump price down and then pump it up. How do they do that? By entering a bunch of orders with a lot of volume. They're dumping millions and millions and millions of dollars into these orders to make millions and millions of dollars by taking people out of the market, right? So notice here, this red line is going to be current price action. Price went all the way down, activated the people for sells. So people are now in sells because they have sell stops. At the same time, they hit the buyer's stop loss. Then what happens is they start dumping money in the opposite direction and price starts going up, hitting the stop losses for the sellers, then activating these other buy orders. So now that they have millions and millions of dollars in a buy direction and now a bunch of more orders are flooding in because of the buy stops, the price typically has a big breakout to the upside. And that's exactly what happens when a stop hunt occurs. That's exactly what happened in this situation here. All of these sellers are activated and then taken out right away, and then price flew to the upside. Why? Because a bunch of buy orders just flew in. It's literally as simple as that. Right now, like I said, there's not always going to be a stop hunt, right? There's not always going to be a time where price is stop hunting, right? News. You definitely want to stay away from news because there's a bunch of stop loss hunts in news, right? For example, this is a live example here, right? I was in a sell on gold, right? My stop loss was literally up here above this high. I was short inside of this range around where these two candlesticks are. I decided to actually sell and I had another sell here. The news event hit and look what happened. My stop loss was triggered along with a bunch of other people's stop losses. Once price actually came back under my stop loss and started trading under the zone again is when I decided to sell again, with the stop loss being somewhere in this range here. And notice how price went down and finally in my favor. Was I right on the direction? Yes. Did I get stopped out? Yes, but I got back in, which made that loss back plus a little bit more. Does that mean you should always get back in on the trade? No. What I knew I was doing was risky and I had the potential to lose more, but I was willing to take that risk because I didn't take a big loss on the first position. And this is another perfect example of a stop hunt, right? So as you can see, right, this is another major level here. Notice how there was no stop hunt. So stop hunts don't always occur, but they do occur. They do happen. This is another example of a stop hunt right here, right? Because again, you know, a bunch of people are looking to take or are taking sell orders in this range up here while others are taking buy orders here, right? So just keep that in mind. I just want you guys to keep that in mind, right? There's not always going to be stop hunts, but they will happen and they will occur. I just want you guys to come to that realization. So hopefully you guys understand what stop hunts, liquidity pools are. They're not really a complicated subject, but it's definitely something I did want to cover. And I'll talk to you guys in the next section. Yo, what's good everybody? Welcome back to another video. So this video is going to be extremely important and we have to understand it. Well, you have to understand it as a newer trader as best as you possibly could. Now, when it comes down to top-down analysis, it is something that you're only going to get better at with time and experience trading. That is literally the only way you're going to get better at top-down analysis, with time and experience. This video may be overwhelming to the beginner trader, to maybe the more advanced trader, It may give you a lot of clarification. But like I said, again, the only way to really improve on trading is really by showing up to the markets every single day and consistently trading every single day and consistently looking to improve, right? So one thing about that we have to understand about top-down analysis, what we're doing is putting all time frames into correlation so we could find the best trading setups, the best trading probabilities, right? So let's kind of dive right into it. I want you guys to take as many notes as possible, replay this video as many times as you possibly could, just so you could pick up on things that maybe you didn't understand before. So when it comes down to top-down analysis, the very first thing that we have to ask ourselves, right, we're going to put ourselves through a process every single day. And that is, we're going to identify the market, where the market's trading, one, right? So let me kind of write this all out for you guys, right? So let me kind of move things over. I have a mess in my office. I apologize. So one, we're going to identify, right? And what I mean by identify is we're going to identify where price is trading, what trend the market is in, and you're going to ask yourselves, what are the moving averages? So this is what I mean by identify, right? You're going to ask yourselves where price is trading. Are we trading at a level of resistance? Are we trading at a level of support? What do the previous candlesticks look like, right? So you can even add that. What does the higher time frame, we're going to add here daily through weekly, look like, right? So this is what I mean by identify, right? So what I mean by identify is where price is trading again, what trend is the market in, if the market's in any trend at all, what are the moving averages, which we'll get into moving averages later on, right? What does the higher time frames look like in terms of the candlesticks, right? So this is going to be the very first step we do when we're doing our analysis and our top-down analysis. We're going to identify what the market is doing. Then we're going to hypothesize. So let's kind of, change this up a little bit, right? I'm going to add this as a title. We're going to identify. Let's make this bigger, right? And then I'm going to, can I make multiple colors? No? All right. So let's italicize all of this then, right? So we're going to identify where price is trading, identify what trend the market is in, identify what the moving averages are, if they're red over blue, if they're blue over red, right? And identify what the higher time frames look like. Then we're going to hypothesize. And what I mean by hypothesize, we're going to, one, it's as simple as that. We're going to hypothesize market direction, hypothesize our targets, hypothesize stop loss. We're going to hypothesize market direction. We're going to hypothesize targets. We're going to hypothesize stop loss. And then all we're simply going to do is execute after that. Right? It's as simple as that. So this is a formula that we have to follow every single day. Now we're going to get more in depth on what we're talking about here later on throughout the course as we advance, but this is what we're going to be looking at every single day when we actually go step by step and perform our top-down analysis. This is what top-down analysis essentially is, right? First, we're identifying what the market is doing. Then we're going to hypothesize what the market is going to do. All we're simply going to do after that is manage our risk and execute. So I'm going to keep this for you guys there. This is maybe something you guys may want to write out and have on a sticky note on your monitor. But when it comes down to top-down analysis, right? For the daily, the weekly, and the 4-hour time frame, we're going to look for, one, the trend. This is how you're going to start. You're going to look for the trend. Is the market in a bullish trend? Is the market in a bearish trend? Right? Along with looking for the trend, you always want to follow the higher time frame trend. Meaning that if the daily and the weekly, let's put here, if the daily and the weekly are bullish, but the 4-hour time frame is bearish, then you could take a lot of things into a certain account, right? Are we looking at a potential reversal? Could the daily structure still be valid in terms of the trend, right? There's so many things you want to take into account, but really all we're looking at is a trend. If the weekly and the daily time frame are telling you buy, then really you should only be looking for buys. Now we can get into things later on, such as supply and demand and everything else. But what I'm going to do is pretty much perform a top-down analysis for you guys, so we can continue on with the lessons and everything that we're doing here. And we can also, let's move this out of the way, perform the top-down analysis here for you guys so we can continue with our lessons, and we can also learn what top-down analysis actually is, right? So typically when you're doing top-down analysis, you want to start off on the monthly time frame and then work your way down. So when it comes down to the monthly time frame, right, what we're going to be really looking at are the candlesticks and how these candlesticks are forming, right? So when it comes down to the candlesticks, as you guys can see, right, this previous month or this current month of November is going to end in roughly 2 weeks, a little bit less than 2 weeks. What I see so far is we've broken above the previous high of the previous month, right? So again, coming down, going back to the candlesticks and wicks section, we've broken above the highs of the previous month, making new highs. Now let's take a look at the previous month's low, right? As you can see here, from comparing this low, let's go back here, comparing the previous month's low to the current month's low, right? This was October's low, this is November's low, right? As you can see, we have a higher low. Why is this a higher low? Simply because this low is higher than the previous low. Now, if we look at November's high, it's a lot higher than October's high, which is right here, right? The top of the wick. Along with that, notice how price is broken above this level of resistance here, 1830, right? You're talking about 3 months worth of resistance was now just broken, right? So there's 12 days left within the month. What I can expect is for this month to close and for the next month to keep going. Where could we keep going to? Right here where we see next level of resistance, right? 1900 is where we can expect gold to go in the short long term. Now, if we go to the weekly time frame, all we're starting to see is more detail, right? So let's mark off, let's go back to the monthly. Let's mark off October's low, October's high. And then let's mark off November's low and November's current high, right? Now, if we go to the weekly time frame, we can see that this right here is October's low. And then this over here is November's low. This right here is October's high. And then this right here is November's high. As simple as that. So what we could start to see here is a market went low, high, higher low, higher high. So we can kind of expect a pullback now. Now, you have to ask yourself, since we're at a higher high, and we know we're at a higher high, where could we potentially expect a pullback to? This is where supply and demand comes into place, right? Because now, if we look at these weekly timeframes, we know that this bullish momentum is holding very, very strong, and we know we're trading at a daily level of resistance. So again, when it comes to the trend, there's multiple things you can use, such as your Fibonacci retracement tool, where we could see the 38.20% is right on the 1830 resistance level, right? And all I really did here on this weekly time frame was look at the candlesticks and looking at my previous areas of resistance and looking at how momentum is holding within this current trend, which is very strong. Now, if we go to the daily time frame, again, we're expecting price in the long term to go to 1920. So there's always going to be more desirable levels for us as traders to take trades from. Now you have to ask yourselves, okay, well, where could we potentially take a trade from, right? or where could the trend potentially pull back to, because we know there's highs and lows and there's higher highs and higher lows within the trend. Now we're starting to see a little bit more detail. We could see that right here was October's low, because this right here September, this is October. So October's lowest point is right here. This is going to be October's higher low. This is going to be November's higher low. This is going to be October's higher high. So let's do the following here. What we're going to do here is mark off November's low, so November made a higher low at 1760. Let's leave it at. And we're going to lock this, but okay. Make sure this is locked. November's higher low at 1760. Then this is November's higher high at 1813. And okay. Right, so now we have our higher highs and our higher lows marked off. So what we can expect for price to do is pull back potentially to this 1830 level. If this 1830 level breaks, then what we could wait for is for price to come back to November's higher high, where we can then look to take price back along up to 1870. Does that mean you can't take a trade before then? Should you only wait to buy? No. You can take counter trends for sure. Just know that when you're actually taking a counter trend, you're looking to get it in and out of the market as quickly as you possibly could, right? You don't want to be greedy with a counter trend, because you know the trend can flip at you at any point in time, right? So again, now that we're trading at resistance at 1870, I have two things that I could potentially do here, right? On the weekly time frame, we know that price is currently trading at a daily level of resistance. Most likely, this week is going to close within this area up here. Why? Because all time frames have to be in sync. Price isn't just going to come all the way back down to 1830 before the weekends, because that's just going to signify that there's not a lot of buying momentum here, which that's not the case. There is a lot of buying momentum. So most likely what's going to happen is the week is going to end, and then the next week we'll see a bearish move, and then the following week we will see a bullish move. And that's how typically things play out within the market, right? If we look at the weekly here, notice how on the weekly it came up to resistance. This week closed. The following week opened up and we had a big bearish move, right? Go back to the weekly and check it out. You could see here, right here, price came up, tested resistance on the weekly, new weekly candlestick opened, price came down, and then continued to actually trade lower, and you could see that on the chart right here. It's literally as simple as that. Once the next week opened up, price saw a really big move down. And that's typically what happens in the market. Again, all time frames have to be in sync when it comes down to these big moves. So that's why we haven't seen a very big move off of gold recently. Why? Because a weekly time frame has to close, and then we could see that big move down to 1830, which is like 300 pips, which again, you can still capitalize off that big move down, because we're trading within a range here right now. Between 1870 and 1830 is where we're looking for our range. Now what could happen is that this weekly could go up and close as a doji, or maybe even a small bullish candlestick, and then the next week continue to trade lower. But again, what we're doing here with time frame correlation and top-down analysis is we're simply looking at the direction and where price could head on the higher time frames, always keeping that in mind and basing trades around those higher time frames. It's a lot simpler than it sounds, but that's the reality of top-down analysis and how you should approach top-down analysis, right? So that was just kind of an intro to top-down analysis. When it comes down to the webinars and when it comes down to everything else, just ask me questions if you ever have a question on top-down analysis. But again, you want to start off with the monthly. Really, the monthly you only want to look at maybe once or twice a week, and then on the weekly time frame, the daily time frame, the 4-hour time frame, you can work your way down. So again, if the weekly and the daily are telling you bullish, just know that the overall trend is bullish. Then on the 4-hour time frame is where you're going to be looking for market direction, so you could take a trade off of. If you know that on the daily time frame you're trading at a daily level of resistance, on the 4-hour time frame you want to look for market reversal patterns such as your double tops, your double bottoms, your head and shoulders, where you could look to potentially take a trade to the next level of support, where you may see another higher low or higher or lower high form, whatever the case might be, depending on the trend. But that's just like a quick breakdown of what top-down analysis actually is and how you should perform top-down analysis. Because again, what we did was we marked off the month's higher highs and higher lows, and we've identified that we're trending bullish here on gold. Then you could go on the 4-hour time frame and identify where price is trading, and you can even mark off your 4-hour levels, here as well. But as you can see, it's kind of just one steep move, so there is no real level, right? We know that there's a higher high right here, there's a higher low right here, there's a higher high here, and that's currently what we're trading at. We know that we're trading at a higher high. It's a lot simpler than it sounds, but that's what you want to do. You want to mark off the month's higher high, the month's higher low, or if the trend is bearish, the month's low, lower low, the month's lower high. If the trend is consolidating, you want to mark off the month's high and the month's low. Then you can even go so on and so forth as marking the day's higher high, the day's higher low. But that's more of like an intraday perspective, where once you know where you are in the trend, all you're simply doing is marking off your higher highs and your higher lows and looking for trade opportunities based off of the trend. That's how you do top-down analysis. I'm going to be doing more of these videos throughout the course. We're going to be doing a lot of confluence videos and then actually looking on where we could take trading setups. But anyways, again, don't forget this process that we just went over right here. So again, you want to identify the trend, but you also want to go through the process of identify, hypothesize, and execute, IEM, right? So anyways, I will talk to everybody in the next few videos. Yo, what's going on, everybody? Welcome back to another video in the Day Trading Institution. So in this video, what I'm going to cover for you guys is time frame correlation. Now, when it comes down to time frame correlation, what we're really just looking for ultimately are for multiple time frames to be in sync, meaning that if we're going to look to sell, we should wait for the daily and the 4-hour to look to actually take sell positions. Now, what I'm going to be doing is giving you an example of gold and how you could actually use time frame correlation to your advantage. So we already have our main levels marked off, meaning that we have our major supply and demand levels marked off, and we're going to be looking to take trades from these levels. So here we currently have two options on gold. Wait for price to come back up and double top off resistance, and then look to take price down to support, or wait for price to come down to support where we'll look to buy and then take price to 1870, because remember, we're trading from zone to zone. So at this point in time, all this shows us is that price has rejected resistance so far and we're actually pulling back. So price is still very, very bullish, and it's not a good idea to look to take a sell position, especially after a candlestick this huge. We go to the daily time frame and we just see the candlestick is still kind of trending bullish, even though there is a lot of rejection to the upside. This was simply sellers coming into the market, right? So let's kind of continue here, and there's no real details to actually look to trade. Plus, so let me break this down for you guys. This is the sessions indicator, right? Green being the London session, brown being the London to New York session, and then the red being the end of the New York session. So there's nothing to do right now. We're not trading. We're not looking to take trades. Now, we could continue here, and let's kind of just wait for London session. And London session, really this is a very nice double top pattern, right? It's closed under, but we always want to trade as close to the level as possible. So we're not going to be looking to take a sell here. We're going to wait for price to come up here and see what price actually does. So we're still here on the hour time frame. Nothing's changed, right? Definitely lots of momentum to the downside, or lots of consolidation. Still a lot of momentum to the upside is what I meant to say, right? And we're still going to wait for price to actually come back into our daily level, where we will look to take a short, because at this point in time, we're not trading. We're not looking to take a sell. We're looking to take a trade. So we're still here on the hour time frame. Nothing's changed, right? Definitely lots of momentum to the downside, or lots of consolidation. Still a lot of momentum to the upside is what I meant to say, right? And we're still going to wait for price to actually come back into our daily level, where we will look to take a short, because at this point in time, it doesn't seem like price is going to come down for support. And even if price did try and come down to support, we basically missed out on the sell. Why is this? Because if price were to actually come down to support, then at that point in time, we'd be violating multiple levels of market structure, and the bullish trend would be very weak, which wouldn't create such a great buying opportunity. Now we're still going to continue to wait, and let's check the daily time frame. Daily time frame, as you can see right now, is trading near resistance, but again, it's not enough detail yet just to look to go short because we had a big rejection to the downside. So we go back to the hour time frame, we see a nice bullish variation pattern, which is an indication price can continue to go up, right? And price went right back up pretty much. Now again, we're still going to wait for that daily time frame to actually come into 1870. We haven't reached there quite yet, but we do have a nice sell signal here on the hour. Is it worth taking a sell? No, not quite yet, because we only have a doji here. So we're going to continue to wait. All right, we don't have enough confirmation just yet. We only have one rejection off of resistance. At this point in time, the best thing for you to do is just simply wait and sit on your hands and maybe trade another one of your pairs while you wait for gold to actually set up. Still no details yet. We're getting closer to resistance, but not quite. And now here we're actually starting to see some rejection. So let's continue and wait for the next trading day. So new trading day, let's see what the daily time frame looks like. Again, price still is not ready to go down. Why? If we would have had a bearish engulfing where we closed under at least the open of the previous bearish candle, then yes, price would look a lot nicer to actually take a sell. But we have only two rejections here on the daily time frame. So we want to wait for the strongest confirmation possible on the daily to verify that we're actually going to continue to go down. Not to verify, but for more of a probabilistic outlook. Now, if we look at this hour time frame or this 4 hour time frame, price is still maintaining that bullish structure quite nicely. So now that we have an engulfing, price has a very high probability of continuing to trade higher on the 4 hour time frame. So keep this in mind, right? This is a perfect example of time frame correlation right here, right? I don't know why my internet's so slow. I'm going to pause the recording, guys, and when my internet decides to be a little bit faster, I'll bring it back for you guys. All right, everybody. So like I was saying, this is a perfect example of time frame correlation. On the hour time frame, it looked like it was going to continue to go down here. But if you check the 4 hour time frame, what you see is a bullish engulfing. And on top of that, what we could definitely see here is so far price trading higher and higher and higher. Notice how each low is getting higher. Notice how each high is also getting higher as well, indicating that buyers are still in the market. So the probability for price to continue to trade higher is definitely there, and you should be as patient as possible to wait and see what happens when price comes into 1870. Now notice the rejection here. Let's check the daily. Daily is still the same candlestick, so this is within the same day. Hour time frame, great. What this tells us here is that there's a lot of selling pressure in this area, and we're going to continue to wait. And we're going to continue to wait. We're going to continue to wait. Let's check the daily time frame. We're still in the same daily candlestick, so we got to wait for the close. See how that looks like. Again, we're still in the same daily candlestick. So unless this daily candlestick miraculously by the end of the day closes down here, it's still not confirmed that we will see price continue to trade lower. Because really what we could look for is an engulfing on the daily like this one, and then wait for price to actually go down. Right, so let's actually wait for price to give us that confirmation that price is going to trade lower. And again, this is a low probability or a medium probability, my apologies, bearish variation pattern, which at this point in time, there's been a lot of signals here for us to take a sell. I still wouldn't take a sell. You want to wait for that retest, and you want to wait for that strong daily confirmation first. Right, once we see, okay, see, this is why we wouldn't have taken a sell here. You want to wait for the daily confirmation. Sometimes you can get an early entry, but it's not always the smartest thing to do. It's a little bit riskier. Okay, this is a different story. Notice how price actually had a big rejection to the upside and then came back down and closed under resistance. If price can pull back to resistance, then that's when we'll look to take a short, right? Nothing yet. Can we get a pullback now? Nothing yet. And it seems like we're going to have a big breakout to the downside, which we did. Now let's check the daily time frame. The daily time frame, we could see that this day actually formed a bearish variation pattern. This is our signal that, hey, just wait for a pullback and look to actually go short. So on the 4 hour time frame, what you could do is simply wait for price to give you that pullback, give you an entry signal, and then wait to actually take a short position. So notice how price came all the way back into resistance for another retest. This is literally your chance to get in the market. Now we have a bearish engulfing here on this 30-minute time frame. You could take a retest because, again, we're trading off the same level, right? Price rejected this level. This is a sell signal here. You can take a trade off of this bearish engulfing candlestick. Why? Because we're still trading off of that same level. Now, what you have to determine is your stop loss versus your target. I'm going to target my next level of support, which is 360 pips away. Does it make sense to have a 360 pip target and only a 50 pip stop loss? No. You want to be as generous as possible with your stop loss, especially when looking for big trades like this. So in this situation, I'm going to have a 70 pip stop loss, and I'm going to gain 300, and I'm going to look to gain 360 pips. Why? Because we want to give price enough room to breathe, but at the same time, we don't want to be too generous with the stop loss, right? So I'm giving price more than enough room to breathe here, because remember, on the daily time frame, we have the bearish variation pattern right here. Price pulled back and closed under resistance, especially when price does something like this, right? Where we have a big rejection to the upside, price comes all the way under resistance and closes within the bottom third, making it a very strong bearish candlestick. Also notice how price broke the low of the previous daily candlestick, right? Notice how price broke the low of this daily candlestick, but this daily candlestick didn't break the low of this candlestick, right? And notice how each one of these lows on the daily, because remember the wicks show us the low of the day, or the high of the day. Notice how each wick is getting higher and higher and higher, and then finally we have the break. So we have higher low, higher low, higher low, then we have lower low, right? Now again, there's many ways to look at this and try and confirm this. I'm taking a very aggressive entry here on the 4-hour time frame, because the 4-hour time frame came up, rejected, and that's it, right? What you could do is you can have a scaled in entry where you take a position that's less risk, right? Now, back to the 30-minute time frame. Like I was saying previously, I'm still gaining 5 times my risk here, even with a big stop loss, which is what's more important, the risk to reward. Now, we're going to go back on the 4-hour time frame, press play, and then we have a medium probability bearish engulfing candlestick, which you can take a more safer entry from there. Now we're going to continue this, and let's look at the 30-minute time frame. Now we have another bearish variation on the 30-minute time frame where we see price rejecting resistance again. This is another entry signal, right? That's where you would take another trade. Let's continue and continue. Okay, now notice how, let's go to the daily. Notice how on the daily time frame, price came up, rejected, and closed under here. This is the current day. Price came up, rejected 1870, and then closed right under, showing us again another rejection. Notice how day after day after day after day, price slowly starts to lose momentum. Notice how each candlestick is getting smaller and smaller and smaller, and then we have one big bearish candlestick, right? And then notice how on this daily candlestick it came up to 1870, rejected, and closed bearish. So when you see this happen, what you could do is anticipate a bearish variation to form. All you simply have to do is wait for the pullback and get in on the pullback. Now, if we go to the hour time frame, what we see is that currently this is the London session, right? We have a bearish engulfing candlestick, right? If we go to the hour time frame, well, technically it's the New York session, right? So we know on the daily time frame, we're going to anticipate that bearish variation because the previous day closed bearish. Remember, this previous day closed bearish, rejecting resistance. So we're going to expect the next candlestick to continue to go down. All we're looking for is a pullback to sell, right? The probability is a lot higher. What I see here is here's resistance right here. Notice price come down, come up to resistance, reject again. Come up to resistance, reject again, and close bearish. If we go to a 30-minute time frame, what do we see? Resistance rejected, rejection, rejection, and then another rejection. So we can actually take another entry right here. And we're in the New York session, meaning that there's going to be volume in this session. And we could put a stop loss up here and a take profit all the way to our next level of support. Let's continue. You see, this is why it's important to use stop losses that will allow price to actually breathe. Notice how price came all the way up, came about maybe 70% to where our stop loss is. But us knowing as traders that we're managing our risk, we're able to hold the position because it's not a big risk to us, right? We set our stop loss at an area where we know if we're wrong, that's where we're getting out. And that's where I determined it to be up here. Now, all we're simply going to do is press play and watch. Now let's check the daily. Again, look at the daily time frame. Big bearish variation to the downside. Once this daily candlestick right here closed under this minor level of support on the daily, and it closed down here, that's confirmation that, hey, we've broken support. We're going to travel down to 1830. That's the next level. And what you could have even done is notice how we broke under the daily support and we closed under. Look how price came back up to daily support. All you have to do is wait for that engulfing candlestick or the variation pattern, which you could have entered right here as well with an aggressive entry. Why? Because it rejected the 20 SMA, and then it also broke support. That is a break of structure. This is a break and retest pattern. You could enter here with a stop loss above, that level there on the daily, and then target that level of support and continue. And then here you have another bearish variation. This is another entry for you. Let's continue. And then price hit our target. So I really just showed you there at that point in time, right? We've broken under 1830 support. We're at another level of support. You can wait for price to come back up to 1830. Let's see what happens. And it just keeps breaking under. So what you could do is wait for price to come back up into 1813 and look to actually sell, because that is our nearest level of support and resistance. But the way this formed right here, I'm not too confident that that's actually going to happen, right? Anyways, guys, just wanted to give you a quick, not a quick lesson, but a more detailed explanation on time frame correlation and bringing all your time frames in together to actually make a trade, or not make a trade, but take a high probability setup. So again, all time frames have to be in sync, right? Let me give you another example, right? Just a quick example here. If price is making higher highs and higher lows, and this is the daily time frame, and you see price come back into a previous level of structure, the price is most likely not going to go up until the daily time frame forms that engulfing. Once the daily forms that engulfing at our previous level of structure, that's a sign for us to actually look to take a buy. Now let's try and find this on the chart, even though it's not really okay. Perfect example right here, right? So notice how price actually broke market structure right here, right? Once price broke market structure, notice the retest and close. This is most likely going to be the next day's candle, and it's actually going to go bearish. Just because price on the 4-hour time frame came here and had this bearish variation doesn't mean that it's going to go down right away, right? The daily has to be ready. Once the daily actually closes, and this day closed, you could anticipate that the following day is going to go bearish. And what happened? Pulled back all the way up to our previous level of structure, came back down, retest engulfing. At that point in time, what you could do is hop down to a 30-minute time frame or an hour time frame. You can see price break support, because remember, there's going to be trends within inside of trends. If the daily time frame is overall bearish, just wait to sell, right? Because the hour time frame, the 4-hour time frame, what it's going to look like, it's going to look like a bullish trend. What does this look like, right? Lower low, lower high, low, double bottom, higher high is what it looks like. It looks like it could start a 4-hour trend, right? But we know that the daily is still bearish. Why is the daily still bearish? It's simple, right? Low, lower high, lower low, lower high. So what can we expect? Price to do a lower low. When price, again, there's going to be trends within inside of trends. When price actually is pulling back on the daily, for the daily to make a lower high or a higher low, the 4-hour time frame and the hour time frame are going to have predominantly bullish structure, mainly the hour time frame. So if we go to the hour time frame, we see an entire bullish trend here, right? Now that the hour time frame has broken structure, and the 4 hour gave us a big bearish engulfing, all we simply have to do is wait for a pullback and look for an entry, right? So there's many ways you could have done this, but in this situation, it doesn't really look like we're going to have that opportunity, and it's not even worth taking an entry right here. We're still not going to take an entry, right? Now we're talking, now we're actually starting to have a pullback to the SMAs. You can even pull out a fib, but this is probably news, so I'm going to draw my fib from the low, or from the high to the low. We've pulled back about 50%. Let's see what the daily looks like. The daily time frame, it's giving us some form of a pullback. So I'm actually going to wait for our signal to take a sell. No signal. Very weak. Now, notice how price came up to the 618, and notice where it ended. It ended at our previous level of support. And look what it did. Support held as resistance. So what do? You have two options. You could take a sell after this candlestick closure, or you can drop down to a lower time frame and wait for a candle confirmation, which the best thing for you to do is always wait for that candle confirmation, because you have a more, not secured entry, but how do I say this? You have a higher probability of it playing out in your favor, right? So if you would have taken that aggressive entry, most likely you would have been stopped out. But now again, let's coordinate the time frames. Let's align them. Price still closed under our previous level of support, and all that shows us is that resistance is holding. They're still selling pressure. So now that we've identified they're still selling pressure, let's go down to a 5-minute time or a 15-minute time frame and wait. So price, they're closed, right? Still, we're gonna wait because we have no real entry. Again, we're still waiting because we have no real entry. No real entry. Now we have an entry. What is this? A high probability bearish variation pattern right here. So what could we do? We could say, hey, well, here we have our previous level of support. Where's our previous level of support? Down here. These are our daily lows and our 4-hour market structure lows. So what could we do? We can go, hey, I'm going to enter now. My stop loss is going to be above this wick here at 64 pips. My take profit is going to be down here at this negative 61.8 extension level, where we have a level of supply and the daily time frame lows. Let's just press play and price hit our target pretty much right away. It's not always going to happen where price hits your target right away, but you want to be as patient with your trades as possible, because there's always going to be opportunity. If you missed out on this first entry right here, then price would have came back, engulfed, this would have been another entry here. You go to a 30-minute time frame, you would have seen, hey, there we go, bearish variation, bearish engulfing right here, or an hour time frame. I mean, if you would have waited for the hour, you would have completely missed out on the trade, but it's going to happen, guys. It's going to happen. Anyways, guys, so hopefully you understood time frame correlation. Don't feel overwhelmed. You're only going to get better with time frame correlation with time and experience. Anyways, guys, if you ever have any questions, feel free to contact me in the Discord, or just wait for one of our peer reviews and ask me there. Hopefully you and guys have been enjoying the course so far. Like I said, I've been working endlessly on this. I'll talk to everybody in the next video. Welcome back, everybody, to another video here at the Day Trading Institution. So one thing before we actually start learning about price action, how to actually trade price action, is you need to understand probabilities. Now, obviously, when it comes down to trading, we trade based off of probabilities, because we're not always going to be right within the market. When we talk about trading and trading probabilities, we need to be able to tie multiple things together that look like they're going to play out in a specific way, so we could take advantage of that probability and potentially make money on it, right? When we talk about trading, the main people that have a problem, or not really the main people, but the main problem with trading is that people really think that trading is really all about technical indicators and reading price action, when really I can make this course 200 hours long of price action, right, and teach very little about psychology, and you're never really going to grow, because anybody can learn price action, really, at the end of the day. Anybody can learn price action and get good at reading price action just with time and experience. But what separates the winning traders from the losing traders is their mindset and their psychology. Now, what I'm trying to teach you guys is not necessarily the reality of trading, but a probabilistic outlook on a certain favor, right? So bringing in the casino example, when you go to a roulette table, your probability of winning versus your probability of losing is not a 50-50, because the casino has an edge over their gamblers by simply implementing a green color instead of just black and red. So our job is to try and take that same ideology and put it into the markets. When we have an edge over the markets, we have a probabilistic outlook on our trading account that it'll grow if we continue to trade with an edge in the markets. Now, how we do this is by tying in together multiple confluences to increase the probability of our trade. Now, everyone is going to have certain ranks for what they look at in terms of confluences, right? But when it comes down to sitting down on your computer, analyzing the market, and trying to understand what the probability of the outcome of the trade will be is a little bit different. What our job to do on a day-to-day basis is look at the probability of what direction price will travel in. Because price can travel in two different ways in a single trading session, and you can make money on either move. What actually matters is the probability of the outcome and you making money. Now, what I want you guys to really establish before you continue on with the course is understanding that trading is a game of probabilities. You're not going to win every single trade every single day, and that's perfectly fine. It doesn't matter. But what we want to really focus on is making sure our winning trades have a decent big risk to reward ratio. Meaning a 10-to-1 risk to reward ratio means that I'm going to be making $10 for every single dollar that I risk in the market. And that's the way that we want to look to trade. We want to minimize our risk as long as possible, or as short as possible, and increase our reward as big as possible, right? You're going to hear a lot of terms like cut your losers quick, or take profit early, or you'll never go broke taking a profit. Yes, while those things are true, it's all about the context at the end of the day. Because again, what our goal is every single day is to focus on the probability of where price will travel to so we can make a profit, while at the same time determining the risk to reward ratio on that trade. Really, what you should be looking at every single day is looking to make 2, 3, 4, 5, 6, 7, 8 times your money. So you know that if, hey, this trade just hit for a 5-to-1 risk to reward ratio, meaning for every $10 I risked on this trade, I made $50 back. I just paid for the next 10 trades. Versus if you're trading at a 1-to-1 or a half-to-1 risk to reward ratio, you're trading at a risk to reward ratio where you paid for the next trade, and the next trade could wipe out all of your profits. What we're trying to do is make enough profit to where if we're going to risk, and if we're going to take risks the following trading day, it's not going to wipe out all of those profits. We still have 4 or 5 trades that are paid for just by that one trade. Risk to reward ratio should be a staple in your trading when it comes down to looking at your trading methodology. Now, when it comes down to probabilities, you have to understand and be okay with the fact that you're not going to win every single trade. It's just simply not going to happen. You also have to be able to learn how to properly manage your risk. So even if you do get that 5-to-1 risk to reward ratio, you're not going to blow all of that profit in one trade. When you're trading at high risk to reward ratios, yes, you may lose more trades in theory, but you're going to be making all that money back plus more in a single trade. So just try to understand that every single trade has an outcome in terms of what side the favor is on, depending on the amount of confluences that you see within the market. Later on, we'll go over confluence trading and everything else. But what I wanted you guys to really have a base foundation of is that we're trading based off of probabilities, right? What's the probability of price going up versus price going down? Why is the probability of price going down a lot higher? Because this, and that reason, right? When you start having more reasons as to why price will go down versus why price will go up, or vice versa, you're starting to build a case where you see the probability of price is a lot higher for you to actually take a short or a sell position on that specific trading day, because again, the probability for price to go down versus up is a lot higher, right? But again, just because the probability is in your favor doesn't mean you will make money. Trading is all about emotional control. When you're in a trade, how you manage a trade, how you get out of a trade, how you get into a trade. It's literally all about emotional control. Me teaching you a strategy is a very simple process, but what I really have to teach you guys is the psychology behind trading. And if you listen to every single minute, every single second of each video I post on this course, or each video I post in general, you're going to pick up a lot of trading psychology tips along with it. Like I said, I can make a video on trading psychology which lasts 2 hours, which could be better than the entire 200 hours of a technical analysis course. Right, because again, technical analysis is something that can be learned, that can be something that you can get better at over time. But understanding trading psychology is what you're really gonna have to put a lot of effort into. And this is where a journal comes in. But anyways, guys, I kind of just really quickly wanted to go over understanding what probabilities is. And again, our job as a trader is to build an edge within the market. How do we build that edge? Simply by determining the probability of what side price is going to go on, or price is going to travel in, based off of confluences. Anyways, guys, I'll talk to everybody in the next video. Yo, what's good, everybody? Welcome back to another video in the Day Trading Institution. So in today's video, what we're going to be covering is confluence. So what I mean by confluence is the term confluence, and definition of confluence is basically when two things merge together. But what I talk about confluences in terms of trading is we're pretty much putting things together that make up a story that tell us that price has a higher probability of going in a certain direction versus the other, right? So when we have more bearish confluences, we have a higher probability of price to go bearish. When we have more bullish confluences, we have a higher probability of price to go bullish. And what we're going to do is we're going to determine a trade based off of our confluences. And what I mean by determining trade is I mean determining the probability of a trade, right? So first of all, what I want to cover before we get into anything is determining whether a trade is a low, a medium, or a high probability trade, right? So typically when we look for confluences, we look for them in one time frame. Now we can look for them on multiple time frames, but typically we want to look for them on at least 1 or 2 time frames, right? So when we have confluences, right, when we have 1 to 2 confluences, it means it's a low probability trade. So when you only have 1 or 2 confluences, typically you want to stay away from those types of trades. They're low probabilities. They don't look like they're really going to play out in your favor, and you want to stay away from those trades. Now, when we have 3 to 4, confluences, I don't know why I wrote confluences, we have a medium probability trade. And when we have a 5 plus confluences, we have a high probability trade, right? So when we have 1 to 2 confluences, typically the trade is going to be a very low probability trade, meaning that we should stay away from the trade until we have more confluences. When we have 3 to 4 confluences, typically we're going to have a nice medium probability setup. And really it's when we have 4 to 5. I want to put 4 to 5 plus confluences here. We have a high probability setup, meaning that we have a higher chance of winning because we have way more confluences in our favor, right? So now what are confluences exactly? Like I said before, confluences are more signals, right? So confluences could be the trend. The confluences could be the trend. Confluences could be an engulfing candlestick and the type of engulfing candlestick, right? So we could put here candle patterns. What else? We have moving averages, RSI. We also have, well, I don't really even, let's not even mention the RSI. We have the trend, we have candlestick patterns, we have supply and demand. We have fibs, not fibs. We have fibs. We have rejections, right? These are all different types of confluences. Later on, what we could do potentially as well is rate our trade from an A or a B trade, because we always want to avoid the C trade. We only want to be taking A trades or B trades, right? So we're going to consider this an A trade. And we're going to consider this a B trade. What we're doing by marking off this is an A trade or a B trade is very simple. We're simply letting ourselves know that, hey, we had 4 or 5 plus confluences on this trade in our journal, so the journaling process is a little bit easier for us, right? So remember, a high probability trade, 4 to 5 plus confluences means that it is an A trade. A 3 to 4 probability confluence means it is a B trade, right? So again, we have the trend, we have candlestick patterns, we have moving averages, we have supply and demand, we have fibs, we have rejections of price, right? Everybody is going to have different forms of confluences, right? Like I said, it just depends on who you are as a trader, which will determine if that confluence is important to you or not. I did not want to turn on this indicator. I wanted to turn on my moving averages, which will determine if that position is important to you or not. What else could we have added as confluence? We can add break of structure. We can add a retest. It doesn't matter. Or we can even do market structure, which is also a zone, right? So right here alone, I have 1, 2, 3, 4, 5, 6, 7, 8 confluences that I literally just marked off for you guys. So you guys could use this as a base to build your own confluences, right? And again, all we're doing is tying in confluences together. So let's look at an example here. So let's say we're looking at price action right here, right? We see price going up, we see price going down, we see price going up, and we see price trading in this zone, right? So let's mark this off here. So let's say you're taking a trade and you're looking at the confluences. Let's say this is a 4-hour time frame, right? So we're writing our confluences down in our journal. 1, we have a previous level of market structure. 2, we have a bullish trend. 3, what else do we have? Let's say the moving averages are blue over red. So we have the SMAs. 4, right here alone, this is already a medium probability setup, meaning that you have a higher probability of winning than losing. 4, what could we add, right? Let's add a bullish engulfing. So referring back to our patterns here, right? We have a market structure. Price is currently trading at market structure, previous level of structure. I completely forgot. We have supply and demand. Let's just say, right, I can't believe I botched engulfing. We already have 5 confluences here. And we know that if we have 5 confluences plus on one time frame, we already know that this is an A plus setup, right? So we know that this first setup here is going to be an A, and you have a higher probability of winning, right? But now let's say price looks something like this, right? We no longer are trading at a level of supply and demand, and we're no longer trading at a level of market structure. You now have 3 confluences, which 3 confluences is a medium probability setup. Now, let's just say the moving averages aren't even involved, right? Let's write off our confluences here. 1, you have a bullish market structure, bullish trend, that's 1 confluence. Let's pull out the Fibonacci retracement tool. Let's see if we're at a retracement level, right? Let's just say it was right here, just for example, again, this is just example purposes, right? 2, you have a 61.8 on fibs, which is another confluence. 3, what else could you add? Let's say price gave us an engulfing. Engulfing signal, right? Right here alone, you have a B setup, right? Meaning that it is a medium probability setup, which you still have a medium probability of winning. It's a little bit more than a low probability. It's pretty decent, but it's not a high probability setup. So what should you do on a medium probability setup? Ask yourselves this. What's the difference between a high probability setup and a medium probability setup? Simple. You have a higher probability of winning. Let's just say instead of you having a, 51%, you now have a 61% of winning, right? On a higher probability setup. So when you have higher probability setups, this is a time where you could definitely enter a little bit more in terms of risk. You could probably be a little bit riskier on high probability setups, and on a medium probability setup, you may want to tune down the risk a little bit. But what I want you guys to pretty much identify here are just the different types of setups here, right? So now let's say, and obviously in the next video, I'm going to be breaking down setups for you guys, right? Don't even worry about it. Let's say you have a setup like this, right? We're at a level of supply, or we're at a level of demand, my apologies, right? And you have something like this, right? So let's write off our probabilities. 1, we have a supply, we have a level of demand. 2, we have a double bottom pattern. 3, we have a bullish engulfing. So right here, we already have 3 confluences, meaning it is a medium probability setup, right? Now, can we add anything else? Maybe not just yet, right? But right here is a medium probability setup, meaning that it is a B setup. This is a B setup. Now, let's say price does something like this. You close your double bottom, great. Let's say price does something like this now. Okay, setup 1, done. And let's go on to setup 2. This is setup 2, right? So we have a previous level of, again, we're at a previous level of supply, right? 2, we have a bearish engulfing. 3, we have the SMAs being red over blue. And then we can also add 4, let's do fibs, right? Because this is probably like a 38.20, I want to say. Yeah, 38.20, right? So here, now you have 4 confluences together, meaning that this is an A setup, right? This is a grade A setup. Maybe you want to risk a little bit more on this specific setup, okay? And then you can, set up the trade however you'd like to set up the trade, whatever the case might actually be is. Really, it all depends on you, right? So let's kind of continue this market structure here, right? So let's say price does this. And we're right here, right? Let's grade this trade. Let's see what type of trade this is. Should we take this trade? 1, we have a break of structure. 2, we have a level of demand. 3, we have an engulfing candlestick pattern. Wow, I'm really bad at typing today. We have an engulfing candlestick pattern. 4, we have the SMAs. And 5, we have fibs, right? So right here alone, we have 5 confluences. So you already know if it's 4 plus, that is a high probability setup. Why is this a high probability setup? Well, 1, price broke the downtrend structure, right? We went from low to lower low, or to lower high to low to lower high, or in this situation a high. We went from low to lower high to low to high to lower low to lower high to lower low to higher high, and then now we are currently anticipating a higher low. So we have a break of
structure, we have a break of trend. 2, we have a level of demand, which we know this is a level of supply and this is a level of demand. 3, we have a bullish engulfing candlestick, which is our entry signal. 4, we have the blue over red simple moving average, which we know indicates that there's more bullish volume within the market. And 5, we have a 38.20 pullback on the Fibonacci retracement tool. So we know that this is a high probability setup. This is a grade A setup, right? So hopefully you guys understand the concept of confluences. But again, what I want you guys to understand from this is just because you have a grade A setup or a grade B setup does not mean you will win. This does not mean you're going to win every single trade. All it simply means is that we've graded a specific trade to our liking, to where we could actually take the trade. If we don't have a minimum of 3 confluences, we are not taking that trade. And when you do have 3 confluences, you know that you don't have a lot of confluences, right? You have enough confluences to take a trade, but at the same time, you want to be very selective with your trades. As you progress as a day trader and you become a more professional, a more evolved, a more skillful day trader, you're going to start throwing away the medium setups. And you're only going to focus on those really high probability setups. Meaning that you're very picky with your trades. You're not entering a trade unless you see 4 or 5 confluences at minimum, right? But you could also take a trade at 3 to 4 confluences, right? Just know that when you take a trade at 3 confluences, you're going to risk maybe 1%. When you take a trade at 4 confluences, you're going to risk a trade at maybe 1% to 1.5%. It really depends on the setup. Trading is very situational. Not every setup is going to be exactly the same. But when you start getting into 5 confluences, 6 confluences, you know that, hey, this is a really high probability trade. I have a really high probability of winning, right? I'm probably going to go a little bit riskier. But just because you're going a little bit riskier doesn't mean that that one trade is going to wipe out 4 or 5 of your last winning trades, right? Just know that you still have that probability of losing. Just because you're trading at a high probability setup, it does not mean you will win. And I can't stress this out enough, because when people have a high probability setup, they typically get a little bit excited, right? They're like, yeah, I'm going to make money on this trade. The words that you want to remove from your vocabulary are gonna and the market will, because the market will do whatever it wants. There's no such thing as the market can't get any lower. There's no such thing as the market can't get any higher, right? You really want to move those words from your vocabulary. Just because you have a 60, 70% chance of winning, there's still that 20, 30, 40% chance of you losing. And there's going to be times where that 40% wins against your 60%. It's very similar to the same thing at the casino on the roulette table. There's still that little percentage chance of you losing, right? And guess what? Just because you lose one trade doesn't mean you're going to win the next. You could lose 4, 5, 6 trades in a row, but win the next 2 trades and make back all those losses plus more. That's what you guys don't understand. Well, what a lot of newer traders don't understand, right? Trading isn't something where you're going to be winning every single trade in a row. You're going to have times of winning streaks where, yeah, you only take maybe 1 loss out of 7 losses, or out of 7 trades that you took, out of 7 winning trades that you took, right? But just like if you were to go to the roulette table at the casino, right? The house has an edge over you because they added that green color, going back to the beginning section of the course, right? There's times at the roulette table where you could literally bet on black every single time, right? And you lose 4 times in a row. It's going to happen because there's periods of losses in the market. It's just going to happen. You have to be able to really manage your risk. And that's how you're going to stay in the game for a long period of time and make money, more importantly. So hopefully you guys did enjoy, understand this little video. I know I kind of went on a little rant there, but throughout the entire section throughout the entire day trading institution, I want you guys, I'm really trying to be as transparent with you guys here as possible. And I'm telling you guys, Trading is made up of 80% psychology, and the rest is simply money management and technical analysis. You can have all the confluences in the world, but you still need to be able to control yourself emotionally. Just think about this. This is a live trade that I took, right? I took a position somewhere along this area here with a stop loss up here, and my take profit one is 2.5 right here. My second take profit is here. My third take profit's here, right? Keep in mind, at one point on this trade, I was up $10,000, $13,000, something like that, around there. Right? I think it was around here. I was up like 10 grand. Then I was up like almost $20,000 at some point. Then price went against me, but I still had the will and the emotional control to hold my position because I know my main target is down here where I'm going to make 30-some thousand dollars, right? And look at price go completely against my position. But I had the discipline to hold to my initial target, which is down here, right? Because I know that if I win this trade, I'm going to make at least 3 times my risk, and I just paid for another 3 trades, right? That's exactly how you want to think about trading. I just won this trade. This trade just paid for my next 6 trades because I'm only going to be risking $1,000 for the next 6 trades, which should, even if I lose 6 trades in a row, I'm going to break even from today's profits, right? Not as simple as that, but that's the concept that you want to look at, right? Anyways, guys, I went on a little bit of a rant there. In the next video, we are going to be going over confluence trading and just break down the charts for you guys so you guys can understand how to perform technical analysis. Yo, what's good, everybody? Welcome back to another video in the Day Trading Institution. So in today's video, what we're going to be covering is simple. It is going to be confluence trading. Now, all you guys have to simply remember the term confluence simply means confirmation. So the more confirmations that you have within a trade, the higher the probability the trade is. Now, what separates our system from most people's system is that we actually have a scoring system that we're only going to be taking trades based off of this scoring system. Now, when it comes down to me making the scoring system, I tried making it as simple as possible, not just for you guys, but for myself as well. So all we're going to be doing in today's video is just breaking down a bunch of trades, right? So I'm going to try and keep this within maybe 30 minutes long. As you guys can see here, we still have everything from last time. So let's go over a quick recap. So when we have 3 to 4 confirmations, that is a B trade, that is a medium probability trade, right? When we have a 4 to 5 confirmations, that is an A trade, right? Let's just keep that in mind. And then down here we have, what some of the confirmations could possibly be. So let's actually cover gold and start breaking down some of these trades, right? So when it comes down to gold, what I've identified is that 1870 is a level of supply and demand. It is a level of support and resistance. Now let's cover this trade right here, right? So now when we're actually looking to take a trade, right, what we could look for with this situation here after this big initial rejection is to look to go short. So if we were to start writing our confirmations, right, we have 1, supply and demand level, and we have 2, a bearish variation, right? And we have a high probability bearish variation on top of that, right? So already off the bat, this isn't enough to give us that entry for the trade. Why? Because we simply do not have enough confirmation. It's not that high of a probability trade, especially that price is still trending bullish. So what are we going to do? Simply wait. In a situation like this, don't get scared. Don't get scared of missing out on the move, right? Now, let's just think, because we have to, again, when we come down to the market, we have to identify, we have to plan, and we have to execute. IPE, identify, plan, and execute. So notice how price is trading down here. You have to ask yourself, okay, well, if price rejects 1870, where could price possibly head to next? And that's simple. Just go back to the daily time frame and look at the bigger picture, right? We have resistance, support here. And then all you simply have to do is look left and find the nearest level of support, nearest level of resistance, which is right here. So we've already identified that price is trading around 1870 and has a probability of coming to 1830. So we're going to wait for one of two things. Wait for either price to come down into 1830 where we could buy it back up into 1870, or wait for price to come back up into 1870 from where it's at for a retest, where we can then look for price to trade lower, right? My stop loss will be above 1870 resistance, and my target will be 1830 support. Notice how I've already identified what the market is doing and I've already planned a trade. All we have to do now is execute, right? And again, we don't have enough confirmations here just yet. So let's continue to wait for more confirmation for us to actually take a trade, right? So let's wait for price to actually come back up into 1870, retest, reject. Now, there's many ways you can actually plan on trading this. You can trade this with the scaling in methodology, where you take an aggressive position and then take a short position. But let's bump it back up to the daily, right? So on the daily time frame, what we see is an engulfing here, and then we see price retest and reject support and resistance again. So another confirmation is to retest, and remember, we have rejection. So now we're at a medium probability setup, right? Let's go back down into the 30-minute time frame. So we know we're at a level of supply and we're at a level of demand. What I'm going to do is I'm going to take one position here. I'm going to take this trade because we are already at a medium probability setup, right? We have a minimum of 3 confirmations. I'm going to take this trade here on this 4-hour time frame with a 1% risk. Why am I risking 1%? Very simple, because we only have 3 confirmations on this trade. We only have a medium probability setup, but we have high probability entry signals, right? So let's go back into the 30-minute time frame. And again, my stop loss is going to be above 1830 and my take profit is going to be, or my stop loss is going to be above 1870 and my take profit is going to be 1830, giving me about 5 times my risk. So now we have a grade B, we have a trade B setup, right? This is the first entry. Let's continue, right? And now we have a bigger engulfing candlestick there. And then we have a medium probability engulfing candlestick, right? It's up to the trader or not if they're going to want to take this setup. But again, it just gives us more confirmation, right? Now what we could do is H4, we have an engulfing off resistance, right? So now we have 4 confirmations. So now our trader has turned from a B setup to an A minus setup, because we need an A for an A plus setup. We need at least 5 or more confirmations with our trading system, right? So it's up to the trader now if they want to take a second position here. In this situation, I am going to take a second position, but only at a 1% risk, just because it is a medium probability entry. Now, just because you have an A probability setup doesn't mean that your confirmation candlestick is going to be in a high probability setup or a high probability entry candlestick. I'm going to repeat that for you guys one more time. Just because you have an A type setup, right, that doesn't mean that your entry is a high probability. Remember, you want to separate the entry signal from the setup. The entry signal is going to tell you, okay, sell now. The actual setup itself is going to tell you, yes, you're most likely, you have a higher chance of winning than a higher chance of losing, right? So in a situation like this, I'm only going to risk 1%. On a regular trade where this would be a high probability setup, I'm actually going to risk 2%. So I have a total risk of 3%, because remember, we have 1 position entered. Now, our first position, we're looking for 5 times our risk. Our second position, we're looking for 4.3 times our risk. So on our first position, all this simply means when we have a 5-to-1 risk reward ratio, it means I'm risking $100 to make $500. On our second position, all this 4.36 risk to reward ratio means is that I'm risking $100 to make $436, right? And let's just kind of see how this trade played out. So again, notice each and every time, this is the 4-hour time frame, meaning that each candlestick represents 4 hours of fluctuation, right? Notice how price went down in your favor 100 pips, which is a lot, right? So you would have pretty much been up your risk already. So you'd be up $200-300 already, depending on your account size and everything. But you'd be up $200 or $300, and just like that, you're almost at break even. Again, guys, you have to be able to sit on your hands as best as possible and let your trades play out, right? So let's kind of continue here, right? So one thing, again, look at this, right? Notice how price came all the way down to here and immediately came back up. You have to be able to sit on your hands and trust in your analysis, right? So now at this point in time, what I would do is move my stop loss to pretty much break even, just because we're giving price enough room to fluctuate. Or you can actually move your stop loss a little bit lower than break even. It's really up to you how you're going to trail your stop loss, right? Let's actually go down to a lower time frame and check for the nearest level of resistance, right? In a situation like this, you want to move your stop loss at least to break even now that price is trading down here, because this is our nearest level of resistance. This is our lower high point, and price is trading all the way down here, right? So let's kind of continue. So now if price actually breaks under this low and actually makes a new low, what you could actually do is trail your stop to about right here, where if price breaks this lower high point, you can actually close your position, and that's active trade management. So I'm going to set a stop loss. My apologies for the dogs in the background, guys, right? I'm going to set my stop loss at about right here, and we're going to continue. And all I'm simply doing is securing profits along the way by setting my stop loss here. So worst situation is I close the actual trade here, because remember, price can go all the way down here, almost at our target, and then reverse against us. So we want to have active trade management, right? So notice how price is continuing to trade lower and lower. Right now, what I'm going to do is I'm going to move my stop loss down a little bit more, just above this level, because remember, price is trading all the way down here now. So I can actually probably move it to right here. I'm going to put it to right where that lower high is. I'm going to continue to hold it. And right there, this is where we would typically get out of the trade. But some people, this happened within an hour. You could have definitely held through that, and that's how you could have caught that move. Again, this was an A probability setup, but it was a medium risk entry on both entries, right? It was a medium probability entry on both of those entries. Now, what I want to do is actually break down a trade that I had taken recently, a loss and a win, yes, right? So when it came down to gold, right, what I noticed is after this move here, after this big bearish move, we have broken under the moving averages, and we've broken under 1795, which is resistance. Notice how many times price came up. Remember, wicks show price movement and where price traveled to and closed that initially, the highest point and the lowest point. Notice how price failed to break above 1795 so many times, right? Now, when it came down to that position, what I did was I actually ended up taking a short position right here, somewhere along this area here. I took a short position here. My apologies, guys. I took a short position here where my stop loss was actually a little bit above resistance and my take profit was down here, right? Notice on this specific trade, I had the confirmation there, right? On the daily time frame, we had a big rejection to the upside, which is one confirmation. You go down to the 4-hour time frame, we have the moving averages. Then you go down to the hour time frame. What you see here is multiple rejections, but you have to keep in mind, the higher the time frame, the stronger the confirmation, right? Then we had a big confirmation here, putting this at a B setup. Now, I had taken a little bit of an earlier entry off of a B setup on this 30-minute time frame, but notice how price still pulled back on me, right? Notice how price came all the way back up, coming pretty close to my stop loss. I want to say 50% of the way to the actual stop loss before going down and actually hitting my first target, which was down here at this level of support. This was my first target, right? Which is support here, which gave me about 2 times my risk, and that's why I took the trade, right? My stop loss was actually a little bit smaller. It was something along this area here because I remember it coming very close to my stop loss, right? Giving me about 2 times my risk on that trade. So when it came down to this trade, it was again a B type setup. But notice one, how the trade didn't go in my favor right away, right? And then price actually came down and engulfed. This would have made it an A type setup, giving me again the confirmation that the probability in my favor has just significantly increased. Why? Because this zone is resistance. All of this is resistance. Again, supply and demand, support and resistance is always going to be considered a zone, right? So again, if I were to list off the confirmations, we have 1, the SMAs, 2, the trend. The trend is bearish. Why? Because price is making lower lows and lower highs, right? 3, we have the engulfing candlestick pattern, and then we can even incorporate this engulfing candlestick pattern there as well, but I'm not going to. I don't like to incorporate multiple engulfings as a way to kind of like increase the confirmation. It's only one confirmation that you get. You can't have multiple confirmations from a single pattern, right? So again, it was a B setup, and then price went in my favor, and then that's where I closed half my position, wanting to run my position to down here, which was other target, and this position got stopped out by news. And then that's where I decided to take a break from the charts and look to get back in. So we can actually use the moving averages as a dynamic form of supply and demand, or a dynamic form of support and resistance, right? So notice how price actually broke support here and then came back up, right? When it came down to me taking this position again, let's list off the confirmations, right? The sells. 1, we have the SMAs. You always want to check the SMAs on the 4-hour time frame. On the 4-hour, they're red over blue. Now let's just go down to the hour and see how things are actually playing out here. We have 2, market structure, right? This is a level of market structure right here. Notice how price came all the way down, back up, down, up, and respected this level, giving us all this rejection, right? We also could pull a Fibonacci retracement tool from here and see that price rejected the 61.8 and then the 50%, right? So 3 fibs, 61.8. 4, we have the engulfing candlestick pattern, and then 5, double top. So this is another trade that I took. Notice how I have 5 confirmations, and I on mainly pretty much the same time frame, being the hour time frame, giving this in a setup, right? Now when it came down to me setting up this trade, I took the actual sell right here, and my target is down here at this -27 extension level, which lines up very nicely with this higher low of November being 1760. Now when it came to the stop loss, my stop loss was a little bit above this high here, giving me a 2.7 risk to reward ratio, but I actually already closed the position over here because it's the holidays and I don't want to hold positions for too long, especially, you know, in this choppy range, right? And that's where I got out of the trade, right? Once price actually broke support here, that was the, okay, you know, we've already broken support. Sellers are showing that they're still strong. And then you go to the daily time frame and you look at the daily and notice how the daily is actually trading under the 50 SMA. At that point in time, all that told me was that there's more sellers in the market than there are buyers. And notice how I'm kind of tying everything in together. We're starting off on the daily time frame and working our way down. Again, when it came to that day, notice how we broke under the 50 SMA, right? Price is rejecting 1795. So the same thing we did up here. Price rejecting 1870. Our target was 1830. I'm doing the same exact thing. Price is rejecting 1795. I'm targeting my next level of support, major support, which is 1760. Excuse me, guys. But basically how you want to set up things, especially when you're looking for moves on the daily, is you want to trade in between the ranges, in between the levels of support, and you want to trade in between the levels of resistance. And that's where I decided to actually close that position then and there, right? Maybe later on tonight, I'll look for another trade where I could, again, look for an entry based off of this level of support and target support all the way down here. We could also pull a Fibonacci retracement tool from the highest point, from the lower high point to the lower low point, which we could see maybe 50%, right? There's so many ways you could look for different setups, but again, you only want to take A and B rated setups, and that's how I've been trading for the last few years, right? So I think I might separate this into two different videos, because I did actually take a trade here on silver as well that I do want to cover. So I'm actually going to make this into, I may make this into two different videos, but hopefully you guys understand the concept by now. I'm going to continue to record videos like this, and you can find way more content on Confluence Trading, throughout the entire course, and then along with that, through all the breakdowns and continuous education that we're doing. So I'll talk to everybody in the next video.